So firstly onto the show today we are going to discuss on tax planning. We are in the month of April and you must be wondering, isn't it too early to call and invest time in this particular decision and topic? But hold on. In the discussion ahead, we are not just going to tell you why it is important to plan your taxes now, but also we'll suggest you ways with which you can not just save some extra penny out there, but also plan efficiently your investment. So let's get started with Mr. Harshvardhan Roongta of Roongta Securities. Harshvardhan, thank you so much for giving your time to ET Now. But before I take my first question, me and my team would like to take this opportunity and wish you a very happy birthday and a great year ahead.
Okay, thank you so much, Rishti. Thank you for this kind gesture.
Generally, would like to understand which are those instruments that people rush into during the last days of the month of March, so that we can elaborate it further that where they should hold on into making those investments, and what are the pros and cons getting into them.
Yeah, so as I said, one you look at accessibility. So you have probably an insurance as a product that people commit themselves to, because as I said, you can issue a check right in the last day of the month, which is 31st March, or you can even give it in the next couple of days, which could be even 3rd or 4th of April. You give a backdated check, and you can actually get the tax benefits of that previous financial year. On the other hand, we find some investors looking at products like ELSS. If they have a couple of days if they're in the 3rd week of March probably, then one product that they can invest into is ELSS, the mutual fund equity linked savings schemes. There, one kind of hesitation comes into if the markets are very volatile. I mean, if they are probably gone up a bit, then they would say that should I invest the entire lump sum at this point in time? If they are going to invest a large amount at one shot because they need to save tax, then the market timing comes into picture, saying that should I be investing that large amount of money at one go or not? But because you don't have the time to your side, you have to finish investing. You too tend to procrastinate again further and think whether what I should do with it. So yeah, these are the kind of products that usually people tend to go in for at the last moment. It has to be a lump sum because you have to finish investing in that financial year. So essentially, yeah, these are the kind of products that people would go in towards the end of the financial year.
Okay, but Harsh, now talking about benefits, like what are the benefits if you spread those investments during the particular year, and what kind of returns, like how better returns you can expect out of that?
Yeah, so Srishti, if I look at this point, I mean, just understand an individual standing in the month of April. So there is a person in the month of April, as is today, listening to us. Every individual, whether you're salaried or you're a self-employed, you too tend to get a fair idea about what your tax liabilities are going to be in this financial year. So right now, sitting while we are talking, most of the people would get a fairly good sense whether they need to save money to save tax or not. I mean, that is what we will already know. Then I fail to understand, if this is the case, then why would you wait till end of March or end of the financial year, or you wait for the deadline given to you by your employer for submission of investment proofs? Why would you want to wait till then? You could start taking the decision and parking your money right away in April itself. Now, for example, if you were to choose a product which is market linked, such as an ELSS, an equity linked savings schemes, there are two benefits if you start right now. The first one being that you know very well that you can invest for certain reasons and life goals, which could be retirement, for example. So now, if you're already planning to save for retirement, ELSS could be a product which helps you achieve that financial goal of yours. At the same time, if you start in April, you could split that money and invest it over the next 12 months so that you can get the benefit of rupee cost averaging. Markets are going to be volatile. So if you come right at the end of the financial year, you will have to possibly, yeah. And if you're choosing to invest 150,000, which is 1,50,000 limit under Section 80C, if you're choosing to invest that much amount, you'll have to invest that at one shot in the month of March. Instead, you could split that money and spread it across the year over 12 months, and you can get the benefit of rupee cost averaging, investing into markets at all points in time. Yeah, so these are, essentially the ideas. You get time to yourself, you can peacefully look at a product, evaluate its pros and cons, and then decide whether you want to invest your money or not, rather than waiting till the end and then just parking money into anything that is very easily accessible to you.
Yes, absolutely. Because what I understand that to have that kind of a mutual fund investments, people go for a lump sum investment as well during those end days of March, and the market timing nobody can predict. So during that budget session, the timing for the market could be not in that much of favor. But going forward, which are those bad investments that they make in rush at March end, and they should actually avoid going into such investments? Any suggestions on this?
Yes, Srishti. So, particularly you have to be very careful of one thing. Imagine you're at the end of that deadline. So you're on 31st March, or you are very close to it, or there is a date which your employer has asked you to submit investment proofs. Now, if you unfortunately reach that point wherein you have to invest and you have to take some decision, make sure that you do not invest in a product that commits you to pay further, like an insurance policy, as I said. If you buy an insurance policy, you are committed to pay for at least 10 to 20 years in it. You may have reached a deadline today, but does not mean that a decision that you take today or an investment product that you finalize today, you will have to pay for it for the next 10 to 20 years. Instead, look for investment opportunities or investment options wherein you have only one time payment. So there is a tax saving bank fixed deposit that you can do, in which, so it could be as simple as you having a bank account, online account with your bank. You go to the net banking and simply create a fixed deposit which is eligible for tax benefits. So that is only a one-time commitment. It may not be the efficient and the best product, but you want to save tax. So yes, of course, that is one thing that you can do. And you're not committed to do this every year. Vis-a-vis, when you compare to an insurance policy, you will have to pay for it every year. The other thing, of course, you can do is if you're comfortable, you can invest in one lump sum into an ELSS product, a mutual fund ELSS scheme, which is eligible for tax benefit. It has a lock-in period of 3 years. So post 3 years, you're again free to do what you want. It does not require to pay every year. So essentially, what I'm trying to say is, even if you have to take a decision and you reach the last moment, do not buy into anything that requires you to continuously pay for it. So one mistake that you did this year, you should not pay the price for it for the next 10, 20 years. So just be very mindful of that fact. If I may just summarize the whole thing into one line, it just says that you have to ask yourself this question. Whenever you pick up an investment product, just ask yourself this question: would I invest into this product if there were no tax benefits available on this? And if your answer is no, okay, so then I would suggest better not to invest in it at all. It's okay to pay tax rather than to invest into something that does not merit independent investment in it if there were no tax benefits.
Okay, so that's a piece of advice for all our viewers. But talking about tax benefits, what sections, like we know the most common one is ATC, but apart from that, which are those uncommon sections which tend to be like skipped from the eyes of the investors, and you would like to highlight them for them, that going forward, these are some of them that they can actually consider looking at?
Well, Srishti, I would say like this. I mean, do not let your investment decisions be dictated by exemptions in the income tax act. So let me illustrate that with an example. As I said, there are certain sections, which are eligible for tax benefits. So you will have certain expenses that you incur, which will help you save tax. So which could be, say, a house rent that you pay, that could be interest on housing loans. There could be, a couple of other things, insurance, Mediclaim insurance premium that you're paying, which is eligible for deduction. So there are a lot of expenses which are eligible for tax deduction. Then there are certain investments where the government encourages you to invest money into certain products, such as an NPS, for example. So there is a separate exclusive section which is, entitlement is only on the NPS. So if you invest into NPS, only then you can take that benefit of up to 50,000 rupees. And if you don't invest into NPS, there is nothing you can do about it. So as I said, I mean, whenever you choose to invest and save tax, let the decision be independent on whether you would invest in this product if there were no tax benefits. Do not let your tax incentives or some benefits that that are available to decide whether you should invest in that product or not. Let me share an example with you. NPS, as I said, has a separate section of 50,000 rupees eligible only for NPS. Now, I don't feel that NPS is a suitable product for me. So I do not invest into NPS and save that 50,000 rupees, and I get committed to that product. I will evaluate NPS independently whether or not there is tax benefit. On the contrary, Mediclaim, the premium that you pay for your health insurance policy, is eligible for deduction under Section 80D. Now ask yourself this question: if there were no Section 80D benefits available, would you still not buy a Mediclaim policy for yourself? And the answer is, of course, you will buy it, because the purpose is not to save tax. The purpose of buying Mediclaim is to actually make a provision for hospitalization for your own self. So whenever you look to invest or buy a product, make sure that you do not get distracted by the tax benefits that come along with it. If you get tax benefits in something that you already want to buy and you need it, great. If you do not get a tax benefit and you still need the product, please go ahead and buy it. So answering your question in one shot, I mean, one, of course, ATC benefits are there, wherein certain expenses and investments that you do are eligible. It's a cluster of a lot of things. So you need to know whether you've already fulfilled that limit. Other than the popular ones, which is also part of the financial plan, would be Mediclaim, which is deductible under Section 80D. There is education loan. The interest that you pay on an education loan from a institution that you've taken is eligible for deduction under Section 80E. So if you're planning to pay for your borrow for higher education requirements of your children, there is a deduction available for that. And a couple of other ones, of course, the NPS that I spoke about. So essentially, these are the ones that is applicable for an individual. Other than that, there would be specific for people who are handicapped, have serious ailments, so there are separate sections for that, but they're more expense related rather than investment oriented.
Okay, thank you so much, Harshvardhan, for highlighting all those sections for our viewers. But lastly, my question is to you that whenever we go or park our money somewhere just to save some amount of penny from the tax money that's then outflow, but that actually impacts not just our current financial position, but people tend to take some kind of a decisions which impact their future goals as well and future savings as well. What's your piece of advice that how should they be going with tax planning and along with that the future planning, their future goals? How should this go in tandem?
Yeah, so this in fact is a very good question, which I've been trying to highlight since the beginning. Is what I'm trying to say. Say, suppose first your thinking process and your planning process goes like this. You identify what you need to save for. So, which could be a couple of life goals, could be retirement, could be a children's education, marriage, buying a house, buying a bigger car or holiday, whatever be the requirement. You first jot them down. Then you think as to what investment vehicle is most suitable for that. So if you have a requirement which is say probably 2 or 3 years down the line, you will choose a product which is accordingly suited for that timeline. It could be a debt for that instance, it could be fixed deposits, it could be debt funds, etc. Because you don't want to take equity risk. At the same time, when you have a long-term requirement of a retirement, for example, then you're choosing equity. Now, when you choose a long-term investment option and the product that you've categorized, that you've chosen is an equity, then you choose the equity mutual fund scheme. Suppose you're going into a mutual fund and you say, I want to invest into equity as an asset class. There is where you try and marry your life goal requirements with a tax benefit. So then you can choose an ELSS fund, which also takes care of your retirement benefits because you wanted to invest in equities as an asset class. And ELSS is a product which qualifies for tax benefits as well. So this is how you will try and find a product which is eligible for tax benefits, but primary goal of that investment should be to meet your life goals. Because if you were to park your money only for tax benefits in a product which is not appropriate for you, then you have no money or less money left to actually meet your life goals. So you will have to first look at life goals and then choose the product whether or not it gives you tax benefits. Remember, life goals are permanent, but tax benefits are not. So today there is tax benefit available under Section 80C. There is a great possibility that the government may simply do away with the Section 80C altogether in the future.
Yes, absolutely. And that's a very nice advice for all our viewers. And thank you so much, Harsh. With this, it's a wrap to this discussion. Thank you for joining ET Now today.
My pleasure.